by understanding the correct time frame that fits your trading style, you will be steps ahead of your journey to becoming a profitable trader. Okay, so by this time I know that you know a variety of trading time frames. Can you give me examples? You start with the monthly. Start with the monthly time frame. Monthly time frame. We come the second
1 hour
time frame. 1 hour time frame. That's a yes. 4 hour frame. 4 time frame. Another example.
daily
Frame. Daily frame. Time frame. Minutes. Okay. Another one. 15 minutes time frame. 5 minutes time frame. 1 minute time frame. We can even go to seconds. All right, but in this case we'll deal with up to 1 minute time frame. Okay, good. So all these time frames, you'll find them in your MT4, MT5, and even in your trading view when we are trying to analyze the financial markets. All right, just about now we are going to categorize them according to higher time frame. We are going to look at which are defined as low time frame. Okay, and we are going to look at the trading styles that apply to these different type of trading time frames. All right, so I will wrap this and try to categorize them according to high time frame and low time frames. Okay, so in this case we have higher time frames, we have lower time frames, and we are going to look at their trading styles when they are applied to technical analysis. All right, so just to start, we have higher time frame. The first higher time frame that we have is weekly. All right, let us start with the weekly time frame. This is the most used high time frame for analysis. Okay, when we go to the lower time frame, you'll find a type of a trader who uses the weekly time frame. Their lower time frame is either the daily or the 4-hour. Okay, their lower time frame is either the daily or the 4-hour time frame. This type of a trader is what we call a swing trader. All right, this type of trading is called swing trading. All right, good. So this is the first example. The second example, we come lower, okay, to the daily time frame. The daily time frame, now it is on the higher time frame. Okay, when we want to look at the lower time frame of the daily time frame, we look at the either 4-hour or 1 hour. Okay, in this case the trading style, we'll call it short-term swing trading. All right, we can either call it short-term swing trading. All right, because of the daily and the 4-hour. All right, yes, but when we come to the 1 hour, we'll call it intraday trading. All right, good. So 3 will have this 4-hour, the 4-hour as our higher time frame. Okay, good. What would be our lower time frame when we consider this as our higher time frame? We'll come to the 30 minutes or 15 minutes. Okay, what do we call this type of trading? Intraday trading. All right, this is intraday trading. All right, good. Now here we'll have at number 4, we'll come down to 1 hour as our large time frame for our higher time frame for analysis. Okay, now what is our lower time frame for analysis? It will be 15 minutes. Is that so?
Yeah.
Or the 5 minutes. Okay, this is where we say that this is the classic day trading. Okay, so this is the classic day trading. Okay, good. What about where we have 1 hour, 5 minutes, or 1 minute? This is where our trading style will do what? We will be scalping. All right, is that clear?
Yes.
So according to your time frame of choice, you will see what trading style fits you. If you love 1 minute and 5 minutes, you are doing scalping. If you're doing 15 minutes, 5 minutes to 1 hour, you are a day trader. All right, 30 minutes, 15 minutes, you are an intraday trader. 4 hours, 1 hour execution, you are a short-term swing trader. Okay, but when you're doing daily, 4 hours, and weekly time frame, you are a swing trader. All right, good. So finish copying this, and then we will go and look now at the multiple time frame analysis. Okay, so I recommend keeping it very, very, very simple. Okay, especially in the beginning, and limiting it to just 2 time frames that you can use. Out of these 2 time frames, one is the higher time frame and one lower time frame. So in this case, you can choose the weekly time frame and the 4-hour time frame. Okay, in this case, you can choose the daily time frame and the 1 hour time frame. All right, in this case, you can choose the 4-hour time frame and the 30 minutes time frame. This is the best combination. All right, not 4 hours 15 minutes. When it comes to the 1 hour here, you can choose 1 hour time frame. Okay, and 1 hour time frame and 15 minutes time frame. Another good combination here is the 30 minutes as your large time frame and the 5 minutes as your lower time frame. So this one goes with that. Okay, and then you come to 15 minutes as your large time frame or 5 minutes as your large time frame, and then on the lower side you have 1 minute. So 1 minute, 5 or 15 minutes. This is always the best combinations. All right, good. Summarize that, then we move to the multiple time frame analysis. Okay, question?
I've noticed
Yes.
in number 4,
Yes.
number 5, we have used both 1 hour.
Yes.
1 hour.
Yes.
Is it a mistake or that's
No,
how it is?
not really. Not really. In this case, we were using 1 hour as our large,
Time frame.
yeah, our higher time frame analysis. Okay, and then we said on the lower side we'll use 15 minutes and 5 minutes. So in this case, we can either use 1 hour or 30 minutes. Then our low time frame will be 5 minutes and 1 minute. So either way, it is correct. Okay, remember there are no written rules on how to use the time frames. You only use what aligns with your trading strategy. Okay,
Yes.
good. So we'll either wrap this and continue with multiple time frame analysis. Okay, and remember, according to my experience trading, using multiple time frames has probably made me more money than anything else done alone. All right, just multiple time frame analysis, starting either from the daily time frame down to the 4-hour time frame and then to the 1-hour time frame. Okay, I can assure you that most beginners like you look at only one time frame. Okay, this is incorrect, and you will come to know this in the long run. But because you are in this class, we are going to learn about multiple time frame analysis. Okay, so what most beginners do is that they grab a single time frame, apply indicators, and ignore other time frames. All right, so the problem with this type of approach is that a new trend may come from another higher time frame and you may not be aware. Why? Because your view is from the small time frame analysis. Okay, so do not just look at one time frame. Be aware of multiple time frame analysis. It is advised that we keep it simple, preferably 2 or 3 at most. Okay, good. So there is obviously a limit to how many time frames you can study. You do not want a screen full of charts telling you different things. Okay, I repeat, use at least 2, but not more than 3, because adding more will just confuse you more. All right, you might even suffer from analysis paralysis. What is analysis paralysis? Analysis paralysis is a situation where a trader finds himself that you've analyzed on the monthly time frame, you've come down to the weekly time frame, come down to the daily time frame, down to the 4-hour, 1 hour, 30 minutes, 15 minutes, 5 minutes, 1 minute. At the end of the day, or you get conflicting analysis in a way that you will not be able even to take on trading positions because of confusing and limiting beliefs. All right, that is what we call analysis paralysis. Okay, so from my own experience in these markets, the best time frame combinations are, let me rub this first and then look at the best time frame combinations. Okay, you either choose 2 or 3 at most. All right, so because right now you are starting, just use 2. 3 are for those intermediate or professional traders. So the best combination is you either take 1 minute, all right, or 5, sorry about that, or 5 minutes, okay, as low time frame, and then you combine it with 30 minutes time frame. This is the higher time frame. Okay, this type of traders, we call them scalpers. Okay, for me, this, I find it to be the best combination. You can either do 30 minutes, 5 minutes, all right, or 5 minutes and 1 minute. All right, good. The second combination is you can either do 5 minutes, 30 minutes as your low time frame, in your low time frame analysis. Okay,
Yeah.
and on the higher time frame analysis, you can do for 4 hours. Okay,
Yeah.
so this is for short term, this is for day traders. Okay, you can either call them short term swing traders or day traders. Okay, another good combination you can take is in case that you are you using the daily, let us start from here. Daily time frame, okay? So here you get 15 minutes, and here you get 1 hour. All right? So 1 hour, so 15 minutes, 1 hour, and daily time frame. Okay?
Yeah.
Good. So here you get intra day
Yeah.
traders. Okay?
Yeah.
Good. The last combination, you can have weekly time frame. You can have weekly time frame as your higher time frame for analysis. Then here you will find daily, and here you will find for hour. Who uses this type of combination? Swing traders. All right?
Yes.
Good. So in whatever you do, please tap into this experience. If you are a swing trader, you want to use weekly time frame for your higher time frame analysis, and either use the daily for your entries and exits, or the 4 hour. If you're not so experienced in the market, do not use 3. Please use 2. Either the weekly and the 4 hour, the daily and the 1 hour, the 4 hours and the 30 minutes, the 30 minutes and the 5 minutes, or the 5 minutes and the 1 minute. All right? Good. So, as I said earlier, multiple time frame analysis describes a trading approach, okay, where the trader combines different trading time frames, all right, to improve on decision making and optimize their chart analysis. All right? So typically, a trader makes use of one higher time frame and one lower time frame. Is that right? Good. So the higher time frame is used to analyze the longer term charts and trend context, all right, in order to get a general sense of the market direction and sentiment. All right? Good. So traders try to establish a directional bias, okay? We can either be long, short, or neutral. All right? So if you're done with this, we will wrap and continue looking at the multiple time frame analysis. Okay? Good. We are moving on well. All right? So we are saying we are looking at the higher time frame analysis so that we may get the general sense of the market. Okay? we're looking at so that we may get the general sense of market direction and sentiment. Is that right? Good. So traders try to establish a directional bias, either long or short or neutral, on higher time frames, all right? And then look for specific trading opportunities in the lower time frames. All right? Good. So here the trader would want to look for directional bias, whether you are long, short, or neutral. All right? Good. They now go to the lower time frames for their entries and trading opportunities. Okay? Any question up to there? No question. Okay? I've just said that the low time frames is used to time your entries and manage your what? Your trading positions. Alright? But I'll freely tell you, one of the biggest mistakes traders make when using multiple time frame analysis is that they start the analysis on lower time frames. For example, the 5 minutes time frame, 15 minutes time frame, or even 1 hour time frame. They work their way up to the higher time frames. For example, the 4-hour, daily, weekly, or monthly. Okay, so this approach by most beginner trader would be what we call the bottom up approach. Okay, this is whereby you start from the lower time frames, then you go your way up to the higher time frames. Okay, the bottom up approach. Okay, I'll tell you why this is dangerous. Okay, so this is dangerous that a trader can find a trade signal on a lower time frames. Okay, it is dangerous in two ways. You can forget to check the higher time frame and then trade against the higher time frame. Okay, you may find that the higher time frame we are bullish. All right, but fortunately or unfortunately, you get a bearish signal on your lower time frame. So what happens is that you may forget to check your higher time frame confluence. All right, good. The second thing that happens in this case on the bottom up approach is that traders tend to manipulate their higher time frame analysis so that it fits into their lower time frame signal, okay, ignoring the important signal on the higher time frame. Okay, ideally this is what will happen in your trading desk. Two things in the bottom up approach: you may either forget to check your higher time frame for confluence, or two, you may know that that is a mistake, but now ideally you want to manipulate, you want to fix things on the higher time frame analysis so that it fits with your lower time frame signal that you've just gotten because you want to trade it. Okay, ignoring the important signals on the higher time frames. All right, good. So instead of using the bottom up approach, we are now going to use the top down method. All right, the top down method of analysis. Okay, what does top down method of analysis say? Okay, so for these two reasons that we've stated, we recommend the top down method of analysis. Okay, now with top down analysis, you start from the higher time frame, then look for trading opportunities based on the higher time frame analysis. You go to the low time frame. Okay, then in this case the trade will fit perfectly into the overall chart narrative. Okay,
Yeah.
if you move from the higher time frame analysis, okay, down to the low time frame analysis, whereby you'll be getting your entries and managing your trading positions. Okay,
Yes.
generally on the higher time frame analysis, we look for directional bias, whether we are going long, we are going short, or we are staying neutral. All right,
Yes.
good. Any question up to where we have reached? We have just looked at the multiple time frame analysis. Any questions? We said that the higher time frame are used for market direction and sentiments. Okay,
Yes.
where we see and look for directional bias, whether we are going long, short, or we are staying neutral. Okay, on the shorter or lower time frame, this is whereby we use for entries and trade management. All right? Good. And I said that there are two scenarios that a trader will come across when using bottom-up approach. It is either they forget to look at their higher time frame analysis for confluence, or they will try to manipulate the higher time frame analysis so that it fits according to their low time frame signal so that they can trade it. Okay, which that is wrong. So if you want to fix this, you use the top down method. So the top down method in this case, we may start from the 4 hour, okay, go down to the 30 minutes and down to the 5 minutes for executions. All right, or start from the daily time frame, go to the 1 hour and then to the 15 minutes. All right, or you can either go from the weekly down to the 4 hour, okay, and down to the 30 minutes. All right, you can even do 1 hour down to the 15 minutes or 5 minutes, okay, and then to the 1 minute in case you are a scalper. All right,
Yes.
any question? It is as simple as that. We have just come to the end of our today's trading class. On the next class, we are going to look at what is margin and how margin affects your trading. Remember, once a while in this journey, you will get an alert or a call from your broker. That alert or call is what we call it margin call. So in the next class, I'm going to guide you on what is margin and how to manage margin in a way that you will not get that stressing and alarming call from your broker. What that literally means is that the moment you get a margin alert from your broker, you are literally blowing your accounts. All right? So we do not want you to blow up your accounts. And it is for that reason that in the next class, we are going to look at margin. Okay? So let us meet in our next class.